sometimes the pre-market show can be very productive putting together the content for the show. And other times it could be like today, Looney Tuesday. I'm not sure what's going on with these guys, all the songs they're singing, but we did put together some good content. We're going to talk about China. We're going to talk about Turnaround Tuesday. We're going to find out if that dip yesterday was the dip to buy for the week. Mitch, you're in control. Roll that intro.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Conan.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
All right, as opposed to Monday, where we started out in the red and we never got green, we've been green for most of the pre-market session, trading up 10.5 handles at 39.80.75. Caught a bid right below the close. That's always a good thing. So let's protect that on any downside. On the upside, there's no number at 4,000, but I'm going to say we got to get back over 4,000 again. Pre-market high just shy of that at 39.90 and a quarter. We have the buck in the red by 33 cents. A volatile day yesterday. TLT, just a quiet rally, up 20 cents, 103.39. Doesn't seem like the Fed heads are having too much of effect on the TLT. Crude, big old rebound yesterday, up $1.70 at 78.94. Oil stocks did not participate yesterday. They are a little bit today. Gold up 14.80, 17.70.20. You have silver in the green, 21.48, up 35 cents. Bitcoin, I think this thing is stuck at 16.3, but got a lot of resistance here at 16.5. And what else do we have here? Ethereum futures. They are trading in the green as well by $44 at 11.9750. Triple D, Mitch, how are you guys doing? I hope I didn't embarrass you with that intro, but Dennis, you didn't get to sing yesterday because Tim didn't come on. You're sure making up for it today.
I was disappointed I didn't do the bushwhacker dance.
Come on,
we'll find some way to entertain you guys here today. We'll find some way. But what is entertaining today, Joel, is the China stocks. They're very, very entertaining. And is this market now just go with China? Is this where we're at? China up, our market's up. China down, our market's down. I mean, this is the catalyst. This is why the S&Ps are rebounding at least slightly here this morning. This is what is driving the bus here today. It's all China.
Mm-hmm. And today, of course, announcing the first decline in the daily COVID infections for more than a week on Monday.
Wow.
And this just comes out today.
Wow.
Perfect timing, right?
Perfect timing.
Some would say.
They know how to tell their numbers.
Yeah, that's definitely one thing that we've always talked about, right? China's auditing process. But
even on the COVID numbers.
Yeah, it seems like even on the COVID numbers, they have a good audit process.
Billion cases around the world. There is none in China, though.
But it seems to me like one of the things that this shows me a little bit is that if the market could get driven by so much of the China stock action, then maybe we don't really have this, rip and rally bull market coming back into the all-time highs type of market. Maybe this has just been what we think it is, and maybe this is a dead cat bounce, and we're here stuck between a range. I think we're stuck between a range between 400 and 390s on the SPY for a while now. I don't know how you guys see the markets, but I can see a range-bound type of trade till the end of the year.
I think so. I think, again, approaching these markets, and forgive me for the long COVID, approaching these markets, it's just chop fest, and it's going to continue to be a chop fest. So, yesterday you're like, oh, here we go, you're selling, and then no, there's no follow through, and then we rally here today. So I think you're just fading all moves, but I don't see that catalyst, like I said before. it's hard to really find the catalyst. It's just like the driver to drive us higher, but it's also kind of hard to find the catalyst. It's just going to tank us here too. We're going to be dependent on the next CPI data, which is coming out in basically 2 weeks. But, until then, we have a few cloud earnings this week, but we're kind of getting out of, the tape bomb season. We're kind of getting out of that. So I think you're right, Mitch. I think if you're fading, that's how you're trading. That's how what's been working in 2022. And I think that's what continues to work in 2022.
And Fed speak, you had Bullard bullying the market yesterday's. You got Jerome Powell speaking tomorrow. But you're right. I mean, we're out of earnings season. China, it seems, it's not even December 1st. I mean, we can't start talking about holiday markets yet, right? We haven't even ended November yet. Yesterday was, it was like, where were the Bulls going to step up? And there was really no reason for them to step up early. They let it get into a little bit of last week's range. But I think today's an important day. I think if we can hold yesterday's low, maybe close right here or tack on another 20 points, make that other run back and get over 4,000. So an important Tuesday. Let's see if we could just hold on, hold that low from yesterday. We got some green on the screen I'm looking at. Really no tape bombs yet. Oil up kind of helping things, dollar wheat kind of helping things. So let's see if we can stay, comfortably above last week's low and set the
And I think just to interrupt Joel, because Comcast is interrupting anyways, I think you just continue to be in this market where the chop is the way to play it. And again, if you're chasing moves, that was 2020's playbook, a little bit of 2021's playbook. It has not been 2022's playbook. People want to go to their scanners. What's breaking out? That's what I want to buy. But breakouts have just turned into fake outs all over the place. Chasing moves hasn't worked as well. Yeah, we've had some sustained moves in the value names for a little bit here, but now they start rolling over yesterday. It's a tricky market to be a momentum player in. It's a contrarian market. The other thing I will say is this market is tricky because if you're doing any type of risk control on swing trades, like giving yourself 2-3% stops, there's so much chop, you're getting stopped out of everything. That's where, it's almost like you got to a little bit, not throw caution to the wind. Never throw caution to the wind. You want risk management. But you've got to understand that you got to maybe widen those stops a bit in this type of market because everything is just choppy. There hasn't been like these, nice, smooth moves. It's always got a pullback. There's always some chop. Same thing on the downside. You think, oh, yeah, I'm just going to short Carvana and, make money. But there's been some ridiculous rallies in there, too. So it hasn't been that easy either. So, again, in contrarian markets, you kind of got to widen your stops a little bit. You got to be fading the move so you're getting in at better prices, meaning you're not buying one way. All of a sudden, Disney, when it comes out with the good Iger news and rallies up $10, it's like, yeah, this is the time for Disney. No, it's not. It's another sell the rip opportunity. Disney's come halfway back. This is just this market. The moves in both directions for the last little while aren't sustainable.
You gonna hit him, Joel, or should I?
No. We talked about that Disney. I don't know. I made my claim yesterday. Till it gets back over a 101, and able to hold that. Maybe get a gap fill in here. I don't know. It just seems like they're kind of flailing here, and I not real any clear direction what Iger is going to do, what the difference between Iger and Jacob is going to do. I know they got some movies coming out and stuff, and the other, Dennis, you talk about the recession. And if that comes to place, I think Disney is going to be one of the hardest ones hits, and then just going back, this thing is the same place where it was in 2016, and we've had one hell of a bull market. So I'll take the neutral to bearish train on it, and I'll go up against your bullish thesis.
And again, people put words in my mouth here. They're, oh yeah, you're bullish Disney. I've been trading Disney to a certain extent. Yeah, long term. I said 10 years from now. 10 years, not 10 days, not 10 minutes from now. 10 years from now, I think you're going to like the Disney purchase. I think we're going into a bloody recession. I never said anything about Disney going to 110 imminently here. I did not say that. I don't know why the chat's saying that. I don't know why you're saying that. I said we went to 101. I said I'd be a seller of the rally. So I said I'd like to buy it on pullbacks down at 90. I didn't get filled on the 90. It went to 102 the next day. So, I mean, people just make stuff up or they hear what they want to hear half the time. But what I'm trying to say is if I believe, and I've said this, I absolutely believe we're going into a recession 2023. It's probably not the best idea to just be loaded up on Disney. That's why I have a half-size position. I've got to own something in the long-term portfolio. I can't have 100% cash, because if I have 100% cash, I'm wrong. I get punished severely because everybody else gets rich without you. And that's not good. That's what causes inflation. That's what causes purchasing power to go down. So you can't just have 100% cash. You got to have some stocks. I have a half-size position in Disney in the long-term account because I think there's good value here. I think it's a good metaverse play. I've said all that stuff. I'm not talking about 10 days from now. I didn't say anything about a trade on Disney here. I said I would buy a pullback. And, that's where, so anyways,
if anybody was talking about a trade yesterday, it would have been, I'll put my hat in there. I was looking at Disney for a trade and Netflix for a trade, but I talked about it with it too. I said that Netflix needed to get going, right? That's one thing that I've been looking for is the relationship between Netflix and Disney coming into play. The big part of that is Netflix's gap towards the upside that I see that it eventually could fill. So I've been focusing on that Netflix chart for a while now, looking to see when we're going to get back above 300. And so that's probably going to be when I like Disney. When
it's hard to do all those towards
that 300.
I'm long Netflix too in the wife's account. It's still hard to come in here and say, Netflix is a buy here at this point in time. You know why? Because it's right $100.
Yeah.
We're in this market where there's just not sustainable moves. We're not in Kansas anymore. We're not in this market where stocks that go up 100% go up 200%. Stocks that go up 100% go back down 50% half the time. I mean, this is the kind of market that we're more than half the time. This is the kind of market that we're in right now. It's what I'm trying to tell you. Just like the S&P rally this morning. I don't know what the hell just hit the tape here in the last few minutes. But the S&P rally is we just lost another, 15 handles here, Joel? Just like that. Boom. Boom.
Yeah.
Chasing moves. So again, let's stop and let's analyze the trading strategies for 2022. The playbook for 2022 is fading everything right now. Not even fading just, the rips, but it's been buying the dips and selling the rips. We've said that probably 1,000 times on this show in 250 episodes. We say it like every day. If you're buying the rip, if you're shorting the dip, you've been getting killed in 2022. Contrarians are winning in 2022. Contrarians go against the immediate move. They're saying because the stock was up $4, it's probably going down 2 tomorrow. That is what continues to work. That is the playbook for 2022. It's not playing momentum. It's not, just jumping in everything that's going up because then the rug pull happens and the momentum subsides.
Yeah.
So, I mean, there's obviously different types of momentums or different types of strategies for different types of markets. And, I've been trained 22 years professionally. I can tell you when we're in a contrarian market, and we are in a contrarian market. Even though the value has had a nice month, this has not been like, oh, yeah, all the value stocks just killing it. There's been a lot of ridiculous sell-offs here, too. I mean, if you just go back to a month and a half ago, the Dow was in the gutter. So we've had a good rally here. Do I want to come in and buy all these value names now? Am I coming in here like Kramer last night saying buy Deere now? It just rallied $100 in a month and a half. And we're probably going into a recession. So just cool yourself. You don't have to buy stocks every single day unless you're a day trader. Day trader, you got to buy and you got to sell and you got to make your money. But if you're a longer term investor, pick your spots, pick good opportunities, pick, where you want to be and go from there. Don't just jump in because you have to swing it. You don't have to swing it every pitch.
That's why go ahead, Joe.
No, I was just going to say, that's why I'm getting cautious up here for the year-end rally because we rallied over 500 points.
Maybe it already happened.
Yeah. We rallied 500 points off that low. I mean, that was a really, really nice rally, 3,500 over the psychological 4,000.
Yeah.
And I just, where's the base going to be? I mean, it's going to have to build a base up here, to rally from. And that's why I'm just kind of sticking with, already with the price action from yesterday, my levels have turned negative on the week. And, and they're going to have to rally we're going to have a 30, 40 point handle rally to get back on the positive for the week. So, if you're looking for the year-end rally, I don't. I just
It could happen.
Yeah.
If you're trying to call markets 3 weeks out, 4 weeks out, you're doing it wrong here too. You're definitely doing it wrong if you're trying to predict a random walk market. We are in a random walk market. Nobody knows what's happening tomorrow. Nobody knows what's happening the next day. That's why day trading is kicking the crap out of every other strategy. It's why my day trading account is up so much this year and my investing account is down this year. It's why. Because you can see the momentum coming in on a daily basis and you can pick your spots on a daily basis. But tomorrow is a completely different day. There's no follow through in anything. So, I mean, you're putting on a swing trade and you're like, yeah, this is the time. And your stock goes up 10%. You're like, yeah. And then all of a sudden falls 10% the next day. Like, what the hell just happened? Because we're not in this nice swing trading environment. We're not in this investing environment. We're in a day trader's paradise here right now. Day trading is killing it in 2022. Take the profits when you got them. That's how you make money in 2022.
Another thing I think to keep in mind that you're stating here is that right now it seems like we're starting to get into a sideways stage, right? There's stages that we do get those little bounces up in the SPY. And now you're starting to see more sideways action. When there's no trend, it's going to be very hard to find consistent patterns.
Oh, yeah.
To find consistent trades, because at the end of the day, that's what you're getting. You're getting sideways consolidation right now. It seems like from around, I mean, you could do it maybe above 400 towards the 390s. And it seems like today we might come back. And there is a kind of daily or weekly trend line you guys can draw that I put the SPY pullback somewhere between 393s at 392s. And then we could still come back for 400 because we've made about like 2 big runs there. I still could see us running to 400, but does that mean we're in for 410s, 420s? I wouldn't be even that far to say that we could go that far. So I think we're going to be stuck in this range. Well, we'll get the downturn, then we'll get another maybe 400 turn, then another pullback to 390s. We could very much be here till the end of the year.
Sounds like a lot of good trading opportunities here, Mitch, and not so much long-term investing opportunities here.
100%, and that's
that's just the kind of market we're in. Yeah. 2020 was like this market where everything pulled back and then you bought the dip and you're like just killing it. And, my long-term investing account just killing it in 2020. And, my swing trading account just killing it in 2020. I haven't done hardly any swings in 2020 because you hold something for 2-3 days and then it turns on you. You could have caught the value rally and there's been some opportunities in the energy stocks. But overall, it's just been choppy, very choppy. And the day trading is really good. Like choppy works for day trading. You're like getting in, you're getting these little momentum moves, these wicked little 6-7% moves intraday sometimes, or overnight. And I like my overnight trading, but holding anything for 3-4 days right now, it just seems like there's just not that follow through. And maybe we're going to change in 2023. Maybe we're going to go into a bear market, like a full bear market. But this isn't even really a bear market right now. It's just a choppy market. So we were in the full bear market for the first part where it was very easy on the short side, just selling every rip, you were making money and everything. But now value stocks rally substantially. You've had a separation. You've had some wicked tech stock rallies. Unity's up almost 80% from the lows. There's been some wicked little rallies in here too. So, just trading, it's moved on to just choppy markets, and it's moved on to a day trader's market. That's what this market is right now.
All right, let's go and we'll check out to see if maybe the retail stocks are starting to give up some of their gains that they've been having. Let's go to Hibbett Sports. Q3 EPS at $1.94, missing the $2.47 estimate. Sales at $433.2 million, missing the $445.73 million estimate. Hibbett sees full year 23 EPS at $9.75 on the low end to $10.50 on the high end versus the $9.66 estimate.
Kind of stock that they like on pullbacks here, but I like it down like 60. I don't know about a 62.
Yeah.
Just Dick, it could be another choppy one too. This is thinner though, so it's hard to like make a call on something. Let's trade 9,000 shares in the pre-market, Joel. I mean, but this is the kind of stock that they've historically kind of bought on dips. So I wouldn't be selling in the hole here. I think I want to see some stabilization, and you never know. But you know, the earnings weren't great, so you never really want to buy stocks on bad earnings.
I like that lower $60 area too. Little gap to fill too, going back to 60.29, and then you had two lows in that same area just above 60. Only, like you said, 9,000 shares, and they whooped it up for already 5 points. But that's what I'm looking at. Have to agree with you there. Coming back on the upside, you got a long ways to go to get to the 66.46. That would be the bottom of yesterday's range. And also, if you want to look like longer term, if this is a if this is a real turn in the stock, and you're going to get a real solid retracement. You went to what 40 to you could be going back to the 55 56 area and taking back half of this move. But for today, we'll be looking at support at the $60 level.
All right, we'll get out of Hibbett Sports. We'll go to the next stock here. Just give me 1 second. There you go. Dogs out of here. Let's go into the next one. This is why Joel was calling us out this morning. Why not have a little fun with Bilibili, Bilibili, Bilibili.
Good singer, man.
Billy,
Watch it now.
Billy.
Watch it now.
Hey, Willy Billy. Hey, we're gonna keep it going. Let's go right here.
Willy Billy.
Prep. You guys know it. All right, let's keep going.
About a thing he saw.
That's why I paused it. I wanted to catch this.
And a woolly jaw. Terrible.
All right. Well, the voice.
That's the long COVID right there, singing.
That's the COVID voice instead of
American
the voice.
Idol. We're gonna do a new
COVID
show.
voice.
Long COVID. Who sings the best when they got long COVID? It's me.
Your internet never goes out when you want it to. I'll tell you that. What's the we got? We
All right,
got
let's get the numbers.
Loss, Billy.
Yeah, EPS at a loss of 63 cents, beat the loss of 65 cents. Sales at 814.5 million, beat the 797.03 million estimate. And it looks like Bilibili is up today. Surf's up, guys. Let's go.
China's up too. So Surf's up, Tide's up, Bilibili is up. Okay, earnings. 1388. 15's like the Rock of Gibraltar up there. So if you're buying this thing anywhere in the 14 handle, I think you're doing it backwards, but that's just my opinion. Maybe get some follow through. I mean, this thing at one time, showing you how bad this bear market has been. $157 back when everybody had to own everything in February of 2021. It went out the board at $12 yesterday. So that's a nice 93% pullback here. But stocks that go from 150 to 13 usually don't go back to 150 anytime soon. I'd be fading this thing at 15.
I think everyone's stuck on Billy.
I'd laid a little bit more. Yeah. If this can hold 14 and hasn't really been impressive at 14.22 was a daily high. That coincides with the pre-market high. So first things first, let's get through that. And then I'm not seeing much at 15. I see another daily high at 15.47 million shares have traded. So, look for a day like Pin Duo. I mean, that all over the place. Tried to give some back, but really didn't. So, once, these stocks, they made the turn. I would not be shorting it. Looking at next target on the upside would be that 15.47.
Yeah, we'll see how the other China stocks react. Of course, they have getting a little bit of a bounce. JD getting a little bit of a gap up today. So we'll see what happens with that one. It's so hard to trade that chart too. Like yesterday, we liked it on the daily, but the action of it gapping around it'd be tough for me even to trade. Seeing that gap up now.
It is a wild stock.
Yeah,
PDD
it's
is
wild.
a wild stock.
These
I trade it
stocks are
sometimes.
wild.
I pair it with JD. I pair all these things. You got the Bilibili, but the JD and PDD do pair up pretty well together. The Bob and the Baidu usually pair up pretty well together. So I pair trade those things. But trading those things just on their own with the overnight risk, it's tough, man. You don't know what the next headline is. Are the cases going to go up? Are the cases going to go down? Are they going to go to lockdown? Are there going to be more riots? Are they reopening Macau? Those are all the questions you got to ask, and I don't have any answers for any of them, so that's why I pair it off.
Yeah, it's tough. It's tough for sure. Let's go to the next one here. We got a pre-announcement here from United Health Group as they're announcing their full year 22 revenue outlook here. 324 billion versus 323.32 billion. They did lower slightly their adjusted EPS guidance. They're still meeting the high end. Their high end range is 2205 versus a 2203 estimate. And they also did kind of a similar move here with their full year 23 revenue. They put on the low end 357, 360 to the high end versus 352. So there's a little bit of mixed signals here in their EPS, but the revenues look good here for United Health Group. We'll see what happens to these stocks. They had a nice little pullback. Looks like it's already been running since then. Do you still like these?
Again, lower beta. Works well in a recession. That's all there. The trouble is this thing's sitting up near all-time highs still. So I just don't want to own stocks at all-time highs. I know in 2020 I want to own all the stocks that are at all-time highs. It just hasn't worked out well in 2022. We pulled back. We had a dip down to 523, and then the money manager's like, oh my gosh, United Health's down $9 when they're getting United Health down $9, and they're coming in and buying it back up. So I don't think it's going to go back down to 523. It's a stock that every money manager doesn't own but wants to own. So you get any significant pullback, you probably do find buyers. But it's kind of, it's not very. If you're looking at a chart, it's moved up from 400 back a year ago up to 530. It's not like I don't see the easy path to 630 on this thing. So I think it's just a nothing burger. I think I'm out, not making a call on it.
540. I would keep an eye on that, whether you're bullish or bearish. Last two highs are surrounding it from the last two sessions. It had big drop to 500, a choppy rally. You're $8 away from that. So I think really, if you're looking for more on this one, you got to get this 540 bid here and then challenge your next daily high. Coming back on the downside, it looks kind of, I'll call 532. If you don't hold 532, that splits the lows from the last two sessions. I see some more downside here, but yeah, too. You had the break. Oh, we're coming back, going down. Now we're back. Monthly resistance, just above 550. That has been like when you had a monthly high here. Well, that's 526.98. But what was last month's high? 558.10, and then this month's high is 555.69. But big roadblock getting through 540 for UNH. Hard to find support if you take out those parallels from Friday and Monday. I'm gonna switch over to. I'm gonna get off this Chrome, and I'll be right back. I'm gonna come back
all
in.
Right, Joel's gonna try to fix his internet issues.
No worries. Hop out, Joel.
Like we said, we're all shorting Comcast rip because this
no
is
worries.
what you get.
I'll give you guys a ticker there that not many people watch in healthcare plans. You guys know I always like to look at like different stocks in that industry to see if there's anything that's setting up here. I like the CNC. This is one that I've never traded before. I don't know if you have, Dennis. But,
I trade it.
Yeah, CNC looks like a nice little setup. On the daily chart, you kind of have like this bearish pattern, but if it can get above here, going in towards 86.90, it's going to be looking really good. Monthly chart has a nice support around the 80s. So another level to watch for, of course, monthly highs. My man Joel would kill me if I didn't mention the 86.61. So look to see if we can get through that point and then just continue going towards the 90s. This doesn't look too bad here. It also has a little bit of a gap up to fill eventually. I'm looking to see if we can get towards that 95 where there's a gap up here. And so it's not a bad one to watch. I also like CI, Cigna. So if you're looking for ones that look like better charts, look for maybe some of these to continue their strength. UNH is kind of the slower one of these. And the way that I look at that also is I take a look sometimes at just RSI daily. Yeah. And you can see the RSI daily on this one is down towards the low end of these stocks. Like Humana is very similar. And you can see that chart doesn't look that great. But the higher end RSIs is like CNC, some smaller ones, and then you get CI, Cigna right behind that. So those seem to be like the leaders in relative strength at the moment. There, I got you, Joel. And you can share your charts if you'd like, and we can go back to those. But yeah, so
They're,
CNC is one that I would keep on watch.
Well, just for an update, they're coming out on Thursday. I told them enough is enough already, so I'll be battling Comcast on Thursday morning.
It sounds like packet loss.
I thought they were coming on to the show on Thursday. I was like, I'll rip them up.
Yeah.
Joel, you bring them. I'll rip them.
Oh, yeah, we'll rip them.
All right, let's go ahead. We'll get out of United Health. We've had a good conversation so far. We've talked about China stocks a lot, some retail, Hibbett Sports, of course, our lovely Bilibili moment. I hope you guys enjoyed that, so definitely smash the like. Now let's go ahead and we can get towards our guests in a few minutes. Looks like we'll have David Trainer joining us in just a few moments, founder and CEO of New Construct. So excited to talk about that. Let's take.
They all want to talk BNS because they know I'm long it, and it did have earnings. So maybe we should mention Bank of Nova Scotia.
Not really a stock that I covered, so I don't even have the earnings. Give me 2 seconds, and I'll pull it for you.
Yeah. So I held it through the earnings report. It's in my long-term account. It's a double-sized position. I bought it because a lot of the banks had rallied, and Bank of Nova Scotia hadn't rallied. I bought it in Canadian dollars, but it's probably about 48-ish. I bought US 47.5. I'm up about 10% in it, so whatever that adds up to, 47.5 up to 53. They did report earnings. It is down slightly in the pre-market. Again, very light volume. Only 5,700 shares have traded, so I'm not reading too much into it yet. Lower beta name, nice dividend, 5.82%. I mean, I think I'd want to dip now to get in it if you were looking to get in this. I'm sticking with it. I got to own something. So, and I do think that the bank stocks, if you go into recession, it's going to suck. But I do think the bank stock's been holding up well. So I'm sticking with this one.
All right, I'll give you the numbers here. Their EPS came in at $1.55 versus the estimate. It beat the estimate of $1.46. Then their revenue missed here. It was 5.73 versus a estimated at 6.02 billion. So just slight miss there, about 4.73% on the revenue, and a beat on the EPS side, about 6%.
If you want to trade the Canadian banks, there's like 5 of them here that trade, obviously, on the U.S. exchanges. RY is the biggest one, Royal Bank, CM, CIBC, Bank of Montreal, which my wife worked at for a decade. I still have a huge position in that from her employee purchase plan. BMO is that one, Bank of Montreal. Bank of Nova Scotia, we just talked about. BNS, and TD is your other big one of the big 5. And so those are your Canadian banks. I pair trade all those things all the time. But
BNS looks like it's got good support in the lower 51 handle. I've seen multiple lows going back from the end of the month, and it had a trading range before earnings, which was like 51 to 52 and a quarter. So if you could get bid back at this area, maybe you test the high of the move. But after the move up from the 40 handle, buyers stepping up. I'll just call it 51.10 if you're looking for a target or a place to try long on the downside. BNS.
All right, so I'll definitely be watching also the banks to see if they start falling off the tape. They started coming back to support. They really didn't break down yesterday. I was watching stocks like Goldman Sachs and JP Morgan, also Morgan Stanley. Going to be keeping my close eye on these. I don't know if they can continue going from here. I feel like the rally's gone too far, but of course, these are the stocks that are in favor with their value names. But let's go ahead. Let's get out of the bank talk. Let's go towards our guest today, none other than David Trainer. Let's get him on. All right, David Trainer, founder and CEO of New Constructs. Welcome back, David.
Good to be back. Thanks, guys.
All right, I'll go ahead and I'll take lead a little bit here.
Just got to.
All right, Mitch is going to take over the lead. We're going to put Joel in the background for a few minutes.
Joel's been having some internet issues, so I'll try to take lead here, David. How you been seeing this rally so far? It seems like, we're finally starting to run to a little bit of resistance. How do you see the rally?
Yeah, look, I think this bear market rally is running out of steam. I think these are all really just to continue to grift more retail folks out of their hard-earned money as institutions are looking to unload as much as they can into these upward swings because they know that there's a lot more pain yet to come. Look, the Fed is not backing off on interest rates, and there are a lot of really bad stocks, bad investments that need to unwind before we settle at a bottom here.
Yeah, it seems like we've been having definitely that rotation where it seems like value names have been the strong names here and growth has been kind of left behind. Do you feel like this can be a prolonged kind of trend that we're seeing here?
Absolutely. I mean, look, we've had growth kind of dominate for well over a decade. And I would say, over the last 25 years, growth has dominated for most of the time. And in my experience in meeting with most institutional investors, portfolio managers, hedge fund managers, mutual fund managers, they forgot what real growth is. For them, real value is. For them, value is just maybe a PE multiple or looking at earnings growth or an ROE number. And all these accounting metrics are no longer reliable. Companies have figured out how to manipulate those numbers. They've been doing it for decades, but they've been doing it in a much stronger way now. And so the bottom line is that most managers have forgotten how to do the homework, to do the diligence. And that's why I think you see people, big firms like Sequoia Capital, doing things like zero diligence on FTX, right? I mean, it's revealed they didn't do any diligence.
Crazy.
Yeah. And I think investors need to take that as a sign that, it's not just Sequoia, it's almost all money managers are doing no diligence, which is why they invest in what we call zombie stocks, or just companies that would make no money and never have a chance of making money. And yet they were able to command multi-billion-dollar valuations over the last several years.
I mean, this is the concern here. I mean, you hit the nail on the head saying the due diligence. I mean, even the Ontario's Teachers Fund, invested into FTX, which, this is one of the most sophisticated and, managing, so much money. And, they obviously didn't do the due diligence either. I mean, there was big names invested into this. And, what were they doing? Just looking, and all of a sudden, it's gone. I mean, this is the kind of market we're in. That, and obviously it's not just the crypto market. There's other companies too. Like you talk about zombie companies, talk about companies burning cash. I mean, who was buying Carvana at $300 a share? I mean, this is just, nobody cared. They were just chasing performance. People were just chasing numbers, trying to beat the other money manager. If that guy's up 50%, I got to get all this risk on because I got to be up 55% to keep my job. So such a tricky market to navigate for money managers when you obviously are trying to beat the indexes or you're trying to beat the next guy, and you're seeing stocks go up 100%. You're like, well, these don't make sense, but I'm going to lose my job if I don't chase them. So now that's the unwinding of all that. And how long does that take, David? I mean, this unwinding of this trade, we think, a stock like Carvana from 300 to maybe 7, maybe the trade's fully unwound, but maybe it's not yet.
We don't think it is. I mean, we think Carvana goes to zero. We think there's, we have like 25 stocks on our zombie stock list. We think they all go to zero.
What are some other ones? You can give your opinions here, and we're just curious. I'm just curious because Carvana seems like one that I would, say that I think I agree with you. Possibly, no, we don't know for certain, but it looks like it's on its way to zero. What are some other ones on that zombie stock list?
I got some lists right here for you. I'll pull it up here at least.
Yeah, there's some new ones that we added, but Carvana was number 1. Peloton was number 2. Snap was number 3, I think. We also got Beyond Meat.
Wow.
Rivian, DoorDash. I mean, come on, DoorDash is not a business. AMC, GameStop. But Dennis, I agree with you 100%. They were chasing performance. Mm-hmm. And I think the answer to your question is a little bit of it's kind of a tough one, right? Because I don't think it's just about like losing your money here in the near term. How do you break those habits? How do you become a money chaser instead of a money manager? Well, that can, that takes kind of a long time to happen for some people. The real question is, how do they become money managers again instead of just money chasers, and not looking to just keep up with the Joneses in terms of returns? Because that's not money management. That's FOMO. That's chasing returns. That's believing in unrealistic returns. And that's not fulfilling fiduciary duties. So what it takes to get people back to recognizing what it takes to fulfill their fiduciary duties, I don't know. But I think it's a long period of sustained pain for people who were not acting in the best interest of either themselves or their stakeholders.
Definitely. I mean, it's not only these companies, right? It seems like a lot of companies got the run for the capital in the pandemic. It seems we were just putting out all that liquidity and they jumped right on it. Same thing that happened kind of in the .com era, right? We create our own bubbles almost with this mentality that we have this infinite, amount of money to just borrow from at low interest rates. And now you've seen it. And who usually pays the price is the retail trader, usually, as institutions usually get around this moment. Now, with these zombie stocks, Is there any one that you feel that is kind of leaning more heavily because of certain kind of fundamentals here, so that we can take a look at the stocks?
All of the fundamentals are really, really bad. I mean, look, Carvana is in the news. I mean, they've got just a few months of cash flow left. Firm we think is in really bad shape. I'd have to go back through the reports, because really what the ones that have the least amount of runway are the ones you want to be the most worried about. So I believe it's maybe it's Oatly. It has maybe 1 month.
Oatly.
Yeah, Oatly. Our model shows that Oatly has 1 month of cash on the books to sustain its burn rate.
Holy.
Wow.
So
And I mean,
they're
you've got
going to
a
be
stock.
outraising capital.
Yeah, and you've got a stock that went from $29 to $1. I mean, I don't know a lot of stocks that go from 29 to $1 and then back to 29. I mean, this just doesn't happen. I mean, and this is the problem with so many people, David, and you can, you've been on the markets a long time, but, for people who just started in the last couple of years, they've been rewarded relentlessly by just buying dips, and eventually my stock will come back. I mean, there's this mentality here that eventually, Lordstown is going to go back to, $15, $20, and we're going to get all our money back if I hold long enough. There's this honest belief that, yeah, it's okay, it's at $1. Even in Bitcoin, like, and I've told this story before. My friend had, or a friend of a friend sold 4 houses, put it all in Bitcoin. If you talk to him today about, this Bitcoin, and he's down like 70%, sold real money, real houses, put it in Bitcoin at 50,000. It's down at 15. And he says, it's okay because it's going to $1 million, and I'm going to be worth this when it's $1 million. I mean, Kathy Wood says it too. So, I mean, it's going to be worth this. So this is what I'm going to be worth. So I don't know the path to get there, but I know it's eventually going to $1 million, and I'm going to be worth that. Like my buddy was calling it the soul trade. They believe this with their soul, David. And to break that, and this is why what the market is doing right now, it's breaking those people. It's breaking those people that believe their Carvana $100 purchase is eventually coming back. It's breaking those people. How long does that take, though? What is the process? And, do these, and you're saying these stocks go to zero. I mean, how do you navigate during this breaking period, David?
I think you sell, right? I mean,
okay, that's a simple answer. Good answer.
I mean,
what do you answer?
Hold it to zero. I mean, nobody in their right mind believes Bitcoin's going to $1 million. And that's part of the problem, is this buy the dip strategy has worked so much that people now have additionally unrealistic beliefs that somehow if they just keep doing that, it's always going to work. And that's to Mitch's point, like the excess liquidity completely fueled that. And both the White House and the Fed play a role in this moral hazard that they actively funded. And how long does it take to people to relearn a good habit? I mean, it's a lot more than 22 days. I'll tell you that. But it's a tough question to ask. If I had a crystal ball and could tell you when the markets were going to get efficient again, trust me, I would. But I think we've experienced a great deal of inefficiency, and it's going to take a long time for it to come back. And people are going to have to feel a great deal of pain before they're willing to give up these unrealistic hopes, especially, Dennis, to your point, when they need to believe it. It's not like a soul hope. It's like, I need to believe this or I'm ruined.
Well, there's truth to that too. I mean, putting all your eggs in one basket, it just goes back to show you in the short term, all this hype and everything, stories can carry stocks, but in the long term, and we said this even in 2020, in the long term, it's valuation that really matters. It's the person that's actually figuring out, and buying stocks and aren't burning cash at this burn rate. I mean, we had this idea that as long as you're growing the top line, the bottom line didn't matter. That was true in 2020. It's definitely not true in 2022. And you grow that top line all you want. If you're burning cash the way some of these companies that you're pointing out, David, are burning, eventually it's going to be a painful road.
That's what a zombie stock is. They're burning tons of cash. They have a limited amount of cash on hand to fuel that, less than 24 months, right? And they have very limited or no prospects for actually ever becoming profitable. I mean, Beyond Meat, terrible business model. They sell ground vegetables, right? As if that's going to somehow be way more profitable than people who sell ground beef at 100 times the scale, right? I mean, it makes no sense. Sweet Green, they sell lettuce, and GameStop and AMC, obviously situations there too. And so, yeah, I mean, Dennis, there's no easy way around this. I just recommend people sell. I recommend they do their diligence. We do have a focus list long, but
what's that list? Do you have that list?
I have that list.
Do we have that, Mitch? Or
Yeah,
don't know if
I'll try to pull that up right now here.
I wanted, David, last time you were on, you talked about the home builders, and it was a pretty, I can't remember which one that you mentioned. Maybe it was Toll Brothers, and you said that, the way that the stock was being priced, it was like they were never going to sell a house again. I don't know if it was Toll Brothers or Lennar, but
D.R. Horton.
the housing underpinnings of the economy. Talk about the housing sector.
Yeah, I think we're probably talking about D.R. Horton. It's on our focus list long.
Okay.
And I believe it is outperformed the market. And that's exactly right. To Dennis's point, we believe in valuation. We believe in diligence. We believe in doing the hard work in the footnotes. And Harvard Business School, MIT Sloan have actually written papers showing that we do that better than anybody else. It wasn't popular for a long time. Don't get me wrong. It's becoming a lot more popular now because people realize they need diligence. And when you do that kind of diligence, stocks like D.R. Horton pop up on your screen because you see, oh my gosh, they're generating tons of cash flow.
Yeah.
And the valuation implies that their cash flows are going to permanently decline. That's the kind of risk reward that works over the long term. It may not be sexy in the short term, but over the long term, when the company's making more money than the market expects it to make, well, that's what you need to buy. Buy low expectations for cash flows, sell high expectations for cash flows. Zombie stocks have extremely high expectations for cash flows, especially for companies that aren't making any cash flow, right? And so our focus list long is the opposite of that. It's the safe, it's the reliable. It's an example of what you see when you do due diligence.
It's companies that have money on the bottom line, that care about the bottom line. I mean, that's what always mattered until we got into these crazy 2019, 2020 markets where people were just coming in and throwing money at NFTs and just
Don't
nothing.
be mad at stories. Stories
The story was
lead
cool,
sometimes.
Mitch. It worked well.
Stories
It worked
lead.
well.
But sometimes you have to look underneath
Stories end.
the hood of the story, right? Yeah, the story can only push it for so long. So I don't think story is a bad thing, but it's going to come back. There'll be a time where story is more in the focus. But I think that one thing that we need to learn is also how to look underneath the hood. So one thing that I wanted to ask David about that he has on this presentation is months before bankruptcy, and how that's a calculation that you guys look at. I think that's something that not a lot of people even calculate or even think about. Yeah, they think about a company going towards bankruptcy, but they don't know exactly how long they have. So explain to us that process and how you look underneath the hood to find that out, David.
Yeah, I mean, Mitch, you're right. You want a good story, and all the zombie stocks have a bad story, right? It's a death ending, we think. But you need story and fundamentals, right? Who said we can't have both?
Yeah.
Who said we shouldn't have both, right? And so, because fundamentals tell their own story, and when someone's trying to distract you from fundamentals to tell another story, that should be a huge red flag. So months till bankruptcy just takes the amount of cash the company has on its books, short-term, long-term cash, all liquid cash on the books that they could use to fund losses. And then we divide that by their free cash flow burn. So if they've got $2 billion of cash and securities on their books, and they're burning $500 million a year, that would be 4 years of cash. All the stocks on the zombie stock list have less than 2 years of cash. Oatly, as an example, had less than 1 month of cash.
Wow.
Right. And that chart you're looking at there is from one of our first reports several months ago, and a couple of those companies have already raised new capital. Carvana had to raise new capital. Freshpet had to have some private equity buyers come in. So, what we're seeing is true. I think Peloton CEO a few months ago flat out said that the company had 6 months left to figure out whether or not it was going to survive. Interestingly enough, they had 6 months of a runway until they ran out of cash as well.
How much does Peloton have left now? Is it still at 6 months? Did they do another capital raise? Because the one thing is they can do a capital raise and they can get more runway, but that dilutes equity holders. So it's still not good news for equity holders because you're owning less of the company.
No, that's right. And good luck trying to get any debt, right? Because debt's a little more expensive than it was back when these guys went public. So I think whatever capital they get is going to be very expensive to existing shareholders. So it's not a good thing if they just learn to survive for longer. The real question is, who wants to be that marginal investor, right? Why do you want to throw your money into the fire?
Yeah.
And they're building it like that, right? Who wants to do that? And I think that kind of speaks to your questions, Dennis and Mitch. When will this end? Well, it ends when people decide to stop putting money on fire. And I don't know when that's going to be. You should ask, some of you guys, other contacts, because We don't understand it. People thought we were crazy for years because, right, when we put Carvana in the danger zone, it was like, I don't know, in the teens or something. And then it went up to over 100 and now it's back down. So we were wrong before we were right, even though we were kind of always right. Question about when people decide to get right in the way they think for somebody bigger, higher than my pay grade.
I think that's definitely something that we're going to have to just keep watch on these companies to see how long they can survive. And it's also going to be, I think, a big factor is how long will it take the Fed to finally pivot, right? Because if they are going to survive, they're definitely going to need these interest rates to probably come back down. So we'll have to wait to see what happens there. David Trainer, appreciate you joining us today. And for the Focus Long list, what I'll do is I'll give you guys the website here, and you guys can go to New Constructs and check it out yourself. I didn't have it with us today, but I'll make sure that we have it for you next time here. Appreciate you today coming on, David Trainer.
Thank you.
Thanks, David.
All right. There you go, guys. Let's take a look into the markets. I'll share my charts. Just give me 1 second here.
We're slipping a little bit on the lows of the pre-market session, so that euphoria you had in the pre-market, moving in on yesterday's low at 39.60 and a quarter. Not much underneath that. You start to look into the lows from last week. So early gains evaporating here. No imbalances are influencing that at all. But it's just been a slow, steady sell-off.
Yeah, the nice rally in China, but our markets are just now in this sell the rip mentality here, and it's hard to break too. I mean, people are concerned. Again, it wasn't a great day for the S&P yesterday. We basically failed right where we were 5-6 days ago, and he almost got a little double top in place too. 402.93 on the SPY, 402.91 from the 2 previous days. Joel and I do look for those technical formations, and they're not good news when they reverse off of them. So I think you're selling the rep too. I think, you may be buying dips on certain stocks. Again, I'm going to go with David and say the stocks that I want to be buying the dips are stocks that aren't burning cash. I'm not looking at the dip for Carvana to jump in here. I thought for a couple of days, I'm like, maybe a SoFi, when stocks started to move, maybe we're going to try this one. I tried it, stopped out. Stocks starts making new lows, stopped out. So those stocks are just tough to call bottoms in.
Yeah, one of the things that it's an easy way to look into the market is getting more into that behavior outlook of the market, right? And that theory outlook of being a hero. You don't want to be playing the hero in this environment. In an environment where it's the buy the dip mentality, well, then I actually didn't see it as a bad thing in 2020 playing the hero. But in this environment, it can really be costly playing the hero. We'll see what happens on the SPY today. Last conversations that we can leave off with. There was some Silvergate Capital news. Definitely keep your eyes on cryptocurrencies. It seems to be shaking things up. Jefferies downgrading Generac today to underperform from hold. Don't know if you guys are long on Generac, but
what a disaster story that is.
Yeah, another one that's coming down really fast, and I don't see it changing around anytime soon.
I mean, we're going to get to a point where the stock is just cheap enough. This is not a zombie company. I mean, Generac does make money. You can look up the P in the background while I'm talking if you want, Mitch. But, it is a company that obviously is very, very dependent on expansion, not recession. So trouble is, I've said this before, if you're going into a recession, the first thing you're not buying is a generator for your house. I mean, that's just a luxury item for a lot of people. Maybe these little generators, maybe you're in troubled areas, maybe you want to have it because your power goes out a lot. There's reasons, but a lot of times it's just in new home builds. They put them in all the new houses. And if you're seeing a slowdown in the economy, we know the home builders have been hit, but nothing has been hit like this GNRC. I do think GNRC is going to be a buying opportunity at some point in time. I would have it on my shopping list. I think it is a decent value stock, but I am very concerned about recession. As much as I'm concerned about Disney in a recession, I'd be way more concerned about GNRC in a recession. So I want to see where we're going. I do believe we're going into recession in 2023. And that's why I'm holding off on these purchases, but it would be on my shopping list.
Wow, first time under 100 going back to 2020. I mean, the next monthly low, you don't want to hear this if you're long. Your next monthly low comes in, I believe, uh, not even in the 90 was your low in May of 29 or May of 2020. Not much there. They're really pounding it on 23,000 shares. So keep an eye on that pre-market low. It could just be one person just yakking out a 25,000 share position. If you're looking for resistance, the bottom of yesterday's range comes in at 100.95, but just an indiscriminate seller here. And who was it a downgrade from?
Johnny come lately.
Is Jeffries.
Yeah, wow.
Jeffries
Man,
come lately.
man, thank you, Jeffries. I don't know. I don't know. We'll see if they use
They put an 85 target on it, so not too bad there.
This isn't a zombie company. So I would say a stock like GNRC. I think if you're buying it at 97 and your time horizon is 10 years, same as Disney, I think you'd be happy. If you think we're going to recession next year, why are you buying GNRC and why are you really buying Disney at this point? So I guess it all depends if you think we're going into recession or not. I'm of the belief that the recession hasn't hit yet, but it's still coming. I think eventually people run out of cash and then it starts to hit everything. And that just hasn't happened yet. So
when I look at the fundamentals, they're not bad. They're not bad already. So it's kind of more along.
Fundamentals are fine right now, but cyclical business. So Disney too, to a certain extent. I mean, these are not recession stocks. So I love Disney. 10-year time horizon. I love GNRC too. 10-year time horizon. If you just close your eyes, buy 97, put it away for 10 years and don't look at it, I think you'll be happy. But I think you're going to get it cheaper next year. Same reason why I don't want to buy Disney 9,500 and was like buying at 90, half size position. I don't want to miss it because what if I'm wrong? I mean, there's always that play, right? Like I'm calling for recession, but maybe I'm wrong. Maybe we don't go into recession. Maybe something else happens. So maybe the consumer just finds more money, continues to find more money. So I want to own something. I just, I don't know GNRC. It's come down so far. I could be talked into it at this price. I'll say that. I could be talked into it at this price.
All right, let's go to Apple. Let's take a look at Apple before we get out of here. I'm sure it's going to be on a lot of people's radars as we've been seeing it yesterday take the hit with the China mention, the protest. But of course, that turned around and it said that, China's coming back up. But now what do you do with Apple? Is this still a sell here? I think it's still a sell, but what do you guys feel? Yeah,
we talk about it every day. I had in the long-term portfolio for 10 years. I said it yesterday. Multiple expansion has carried the price on this thing. I think we're going to a period of multiple contraction. The earnings are still there. It's sticky. People want to own their iPhones, but if it really gets hard during a recession next year, it's not the stock you want to own. It is not cheap relative to itself. It traded with a P of like 12 to 13 5 years ago. Now it trades with a P of 24 to 25. So basically multiple expansions doubled the price. I've hedged my entire position because I think there's more pain ahead for Apple.
If this, and I'm going to look at this to point towards the market too, because it's we're pulling back off the high in the S&P, we pull off the recent high in Apple as well, and I'm looking at this 140 area at least right now. 139.50 was your low on November 10th. Right now, it doesn't look like that's an imminent price that we're going to. But if Apple can just somehow develop that, first of all, not get more bad news, not get picked on by anybody, but if it can put a couple lows in this area above this 140, I no reason for it to turn up again. If keep getting bad news, the S&P start heading for last week's low, then you start holding out to you can hold out for that 139.50 area. Obviously 135 has been the major support, so that's what I'm looking at. Apple trading up 36 cents today, getting hit. I mean, there's another thing you could look at it too is like a lot of bad news. Well, it's going down, but it's not getting killed. So.
Yeah, but it has really 180 to 144. I think there's a lot more pain ahead. It hasn't been killed like the other ones because everybody's like, oh, it's Apple. And you own Apple, you don't trade Apple. We hear it from Kramer all the time. And it's been a fantastic call for the last decade or even longer than that. But I just think like we've been in this easy period for Apple. I think it gets harder from here. So that's why I just don't know why 24, 25, you say you have to pay a premium for Apple. Well, you didn't have to in 2018. So why do you have to in 2022? Are you just making an excuse to buy it? Or is it really need to trade with a premium? I don't know if it does. I think it's a staple. I think it's a cash cow. Until they come out with the flying car, until they come out with a whole new product and diversify themselves away from iPhones, which is over half
Need
of
to
their
do that.
revenue.
Yep.
It's hard to say it's anything more now than a consumer staple. So I'm at this point where I don't think it needs to command such a high PE multiple. You can say, well, Procter & Gamble's got 23, 24. But you know what? We go into recession, people still buy Procter & Gamble's. They are running out to buy new iPhones in a recession? Maybe not.
What, just to finish up here, what about deer and cat here? We're talking about these.
I'd
you know,
sell
the
them both.
Yeah.
They're both near all-time highs. If we
Well-
go into a recession, these things are going to be value traps. So there's certain stocks, and Toronto Dave made a fantastic point in the chat about 20 minutes ago, 10 minutes ago. And he was saying just, going and just looking at PE, and that's in just buying low PE stocks and, selling high PE stocks doesn't just work. You got to look deeper into it. Some businesses are cyclical. What that means is their earnings go way up during periods of expansion, and their earnings come back down during periods of recession. We see it with the steel companies. We will see it with a deer and a cat. These are cyclical businesses. If you believe, and I do, that we are going to a recession eventually, a Fed-induced recession by the rising interest rates, eventually this run to low PE stocks like Deere and Caterpillar will end in tears. So as much as Kramer was saying buy Deere yesterday at all-time highs, I will tell you, in my opinion, you sell Deere now, because I think the run has been ridiculous. I think everybody's just attracted to it because it has a low PE. If we do go into recession, there's going to be less farming equipment sold next year. So maybe I'm wrong with the recession call, and maybe the Fed's going to navigate this soft landing, even though I don't know if they've ever done it before, but maybe they're going to do it. But the recession, it's not like we didn't go into recession. You've been wrong, Dennis. I think it's just a fact that, we just haven't got there yet. I think people have stretched themselves thinner. Consumer is still not completely strapped for cash. They're sitting on a lot of equity from their homes. They're sitting obviously on, still some of their savings are exhausted, but they're racking up the credit card debt. It takes time to break the consumer. And that's what we're seeing here now. But I think eventually we do that. I think eventually businesses struggle. I think eventually we go into recession. I don't want to own deer or cat. Drug stocks, completely different type of PE. So drug stocks, which have similar PEs to Deere and Caterpillar, are not cyclical businesses. Why? Because people still take their pills.
Still need their drugs.
They need their drugs, even if they can't. They'll find the money for their drugs. They may not find their money for their new John Deere rider, but they'll find their money for their pills. That's why stocks like UNH have a relentless spits. Why stocks like Merck and Pfizer have started to come back, and AbbVie are making new all-time highs. It's these stocks that will hold up during a recession, especially if they have lower PEs.
All right, I'm going to hop. Let's make sure we defend that low from yesterday, 39.60 and a quarter. Everyone have a good day. Back with you later on.
All right, we'll see what else is going on there. You guys can follow Joel Elconin on premarketprep.com, Premarket Prep Plus, and we'll go ahead and wrap it up. We'll see what happens today. Dennis, can we get a bounce back? I still feel like, we've been saying for a while that the path of least resistance to the upside. I think that statement, for me at least, is slowly starting to die out. I don't think it's the path of least resistance no longer is to the upside. I think now it's kind of more in the chop zone.
I think so too. And I do think I think when we look long term, 10 years, I think you can be buying some stocks. But if your time horizon is 18 months,
yeah,
I don't think you're buying anything, because I think 2023, and people don't want to hear this. They want to hear that we're going to get all our money back in 2023. I don't think that is happening. I'm just of the opinion that it's going to get uglier here yet. So I want to own some stocks in case I'm wrong, but I want to have a lot of cash in case I'm right.
All right, we'll see what's going on there. I'll be watching this SPY trend line. I've been looking to see if we're going to run into it on pullbacks. That's why I'm stating that 392, 393 area, because it would run right into that. But you guys know I like my technicals. I'll get you out of here, Dennis. You have a good one. Do what you do best, my friend. Go get into some trading action. Have fun. See you next time.
Thanks.
All right, there you go. We'll get you out of here. We'll get you now to Benzinga Live. Of course, you guys want to come over to Benzinga TV where we do some live trading. Got Benzinga Live with AB and Stock Market Movers. Excited to get into some trading action. We should have Lord Ryan back, Zunaid and I ready to get into the markets. We'll see what's going on. And I do want to address something that was stated in the chat. Someone got a timeout for a certain reason, stating that, talking about SPACs and NFTs and crypto. And one of the things that I would state there is that a lot of people don't understand that there's opportunities that sometimes you got to take some profit, right? I feel like in the SPAC situation, right? Yes, it was a capital reach. It was a bubble, but a lot of people were able to make and generate a lot of wealth in these SPACs. The key was taking profits, right? And so if there's anything that I've learned is that these bubbles will come just like the meme stocks. And if you didn't take your profits, well, you learn your lesson, right? And I think that in this case, we can't be looking at SPACs and let's say crypto as so negative because of where it is now in present moment. But look back and look at the opportunities, right? You had your opportunity. Sometimes you miss your shot and you miss the investment. Well, that also happens. And another thing to understand is that the buy and hold strategy makes sense for certain stocks. Certain stocks that have high risk are not going to be probably the best in the long term for the buy and hold strategy. This is something that is, talked about often, but at the same time, that's not always the best strategy, just buy and hold, right? And so one thing I'll do is just kind of state that because I feel like too many times people just want to be negative towards these different investment vehicles. And the big reason of that is where they are today versus where they were a year ago or beyond that, right? And so we need to learn from these lessons, not necessarily just be the Debbie Downer. Well, just wanted to state that so that you guys can keep moving forward. Hit the thumbs up if you guys appreciate everything we do for you right here on Benzinga. We'll keep you going with Benzinga TV up next.